Hey everybody, it's Pookie's Revenge, and I'm gonna blow your mind. What's up everybody, this is Pookie's Revenge. I talk a big game, but I'm no follow through. So today I want to make an episode really quickly. I don't have a whole lot of time, but I want to crunch this in here. You guys are ready? So I want to talk about the 1% rule. And it doesn't just have to be 1%, it's just what the rule is called. It's a very old strategy for position management in which allows you to take multiple, like a variety of risk ranges and ultimately just have the same end result. So I did make an episode about this not too long ago. And by that I mean maybe it was like a couple of months ago. But I want to touch up on it again because it kind of fits into the 20 MA strategy. And I got a bunch of you guys asking me questions. So start to finish, okay, this is what we're going to do. And for legal purposes, I can't tell you what to do. I can't give legal advice, but I can give you education and I can tell you what I do, and then you can make your own decisions, and that's awesome, right? Scrutinize me. I openly encourage it. If something doesn't make sense, I don't want you guys to do it. If it does make sense, you can consider it for yourself. So it's pretty cool. All right. So 20 MA strategy using the 1% rule. So for just a really quick recap, the 20 period moving average is just an average of the 20 most recent candles closing prices for each plot point. So basically all we do is look for this to have a positive slope. So the line has to be going up from left to right. So it's just shapes and colors. At that point, we look for a small red candle like this. Or maybe there's a different one over here. That's kind of far away, but right here is a good one, but the slope is negative, so we can't use that one. On, right? This is a weekly time frame, so there's not going to be a whole lot of data there for this stock, but it is what it is, right? So positive slope, and then you've got a small red candle, and then we really want to set the entry right above the opening price of that red candle, so right above the body itself. So right here would be the entry threshold, and then the stop loss is the lower of these two candles that are participating in that color change. So we're just looking for red to green. If your color scheme is different, it's bearish to bullish. And that's all we really look for. So let me just kick this back to the daily so you can see some examples here. So here's one that's perfect, right? It's a small red candle. Moving average has a positive slope. We get a color break right here. The stop losses go right here. This goes up. We take a predetermined take profit at a disproportionate 1-to-2 ratio. And the stop loss just stays put till we get things like higher lows and all that good stuff. So there's a lot of video episodes that I've made about this specific strategy, so I won't bore you to death, but I just want to recap it because we're going to need it. All right. So the first step that we want to use when we consider trading anything is position sizing, right? Because that is the number one risk management factor that we can ever put in place, and we shouldn't be trying to make those decisions while we're in the trade. So we want to make those decisions long before the trade, okay? So this is typically like on a monthly basis. You just want to kind of revisit this and be like, am I using the right amount of money? Right? And so we'll get into all that stuff later. But everybody should have a max amount that they want to expose to speculation at any given time. Okay, so if you have like a $10,000 portfolio, you might put 70% of that into investments and passive income. You might put 30% into speculation, which is looking at charts and buying stuff and, selling when it goes up or cutting a stop loss when it goes down. That's speculation. Investing is where you look at the company, like their financial books, the income statement, all that good stuff, figure out what kind of partnerships they have, their valuation, all that more in-depth stuff. So for speculation, which is what this is, you should always have a maximum amount so that you don't dip into that investment stuff, because that's where the stability comes in. Okay? So and when I say you should, it doesn't mean that you have to. It just I encourage it, but I can't legally tell you what to do. So within that speculative amount, you should have, in my opinion, a trade amount, a per trade amount that you won't exceed, okay? And if something is tempting you and it just doesn't fit your plan and you break that and you trade it anyway, that's over allocating, and that's something that you should be making a note of because that's FOMO. And that's where you get hurt, is when you deviate from your plan. So the whole point of all this is to be as consistent and safe as possible. So if you find yourself deviating from that, that's worth identifying and working on. Okay. So once you got your max dollar amounts, like you've set aside all the all the Pokemon you ever want to send into that fight, you shouldn't be adding more Pokemon into the mix halfway through the battle, right? So you have a per trade amount, a per ever account, right? Amount, I'm sorry. And then that's all you're going to work with, right? The rest of the money just sits on the side. It's doing work elsewhere, right? Doesn't matter. It doesn't exist, okay? And then once you find a chart that you like or a ticker that you like, maybe you've been watching something for a while, you got the setup, and the day before it had a tiny red candle, positive slope on the moving average, and you're ready to look at it, right? You're going to identify the setup, all right? And it doesn't have to be this strategy. I'm just using this for demonstration purposes. It's one of my favorites, and the Rags to Riches team members love it, but you don't have to use this specific one. If you like this strategy and if you're going to use it, though, this is a step-by-step walkthrough. So step one for the analysis portion is going to be to identify the setup. So in this case, if we're looking at the daily chart here, let me just erase all this stuff, and I'll just start fresh. So Get Wealthy, one of the team members, identified this guy right here. So small red candle, he had it on a watch list. Okay, and I'll put this right here so we can see exactly what he saw at the end of the day. Wherever it went. There we go. All right, so this is what he saw at the end of the day. He pulled it up on a screener and he was watching it, okay? So the very next morning, okay, I've got the setup, and I know with this strategy where my entry threshold should be, and that's going to be right here, right above the red body open, right? Because the next candle is going to go up or down, or it'll stay inside this one. There's only one of those three is going to happen, okay? Then I identify my stop loss threshold. So when this next candle opens, the stop loss should be down here because this is the lowest price point that it's been. We could ignore everything to the left here. We're just looking at this candle and the next one, okay? So if I break this down to, let's say the 1 hour chart, okay, we can look at this candle. It's back here somewhere. There it is. Sorry. Oops, sorry. I lied. It's over here. I'm all over the place. I'm going back to the daily. I'm lost. I want to go home. All right. So we've got our red candle here. I think the replay's messing me up. Now the next day, right, the very next morning, I'm going to have this level here as my threshold as soon as the market opens, and I'm going to have this as my stop loss if this gets triggered. If this doesn't get triggered and the price just shoots down, it doesn't matter, right? I'm not going to be getting into this trade. But what I do have here is a risk range, right? So when the price goes up and breaks over this level, I'll look for an entry. And if I enter, then I have a stop loss right here, which means I need a target area as well. So what I can do is I can take, again, at any time, as soon as this candle closes, we can do this. We can move our values in here with a position tool. So what I can do is I can take the opening price here, which is 604, 605. So let's set that to 605, 605, right? And then the stop loss here, let me just see what the low is here. So the actual low for this candle is 566. So we're going to set that low, or the stop loss, to 565. Okay, 565. All right, or below it, it doesn't really matter. I'm just going to draw it here. Okay, then I know I need a 1 to 2 risk reward minimum. Okay, so I can grab that. That 685 value, my profit level, is my profit threshold. So that's where I'm going to look to lock some of those profits. Whether it's all of them, whether it's 75% of them, really doesn't matter. It's up to you as an individual, but if you're just looking to be mechanical, that would be your 100% lock profit. But what we have here is I'm sorry, I'm going to move this down to 565. What we have here is a risk range, okay? So if I enter here and I stop out here, this is the max range that my dollars will be exposed to risk. So what I can do now with that, now that I've got my risk range, my stop loss, and all that good stuff, I've got the trade set up, okay? And I'm guaranteed a net profit if I sell most of the shares up here. That's just how the math works. It's pretty cool because the remaining shares have to go that much farther to the downside, and they stop out before they can do that, so it's a net profit, okay? So what can I do with this? Where does the 1% rule actually start to matter, right? If I take 2 trades, right, and this one here is a 6.61% risk, and I take another one, it might be 3% risk, okay? If I use the same dollar amounts for both those trades, I'm going to get 2 different results, okay? Whereas if I use something like the 1% rule, they'll be a lot closer in size, right? And we can expand this up. If this is a 19% loss, we can still have the same dollar-wise loss, and then in turn the profits are twice that size. So if I want every single one of my trades to yield me, let's say I'm on a smaller account and I want to do $2 losses and $4 profits, I can do that no matter what the risk range is. This can be down here, it could be up here, it could be this tight. I can make sure that they're all relatively the same size to the best of my ability. Now there's going to be some slippage when it comes to actually buying the shares and getting filled and things like that, so keep that in mind. But you're going to be a lot more consistent with the the actual yield, the dollar yield on your trades if you use the 1% rule. So what is it? Okay. So I'm going to pull out a calculator here. And the first thing that I need to do is figure out what my risk range is in cents. Okay, so in this case, it's 40 cents. Okay, 0.40. Okay, and if I'm using $200 to trade with, 1% of that is $2. Okay, so if I just want to lose $2 maximum on any trade, and this one has a 40-cent risk range. Apologies for that. I had to pause the stream. There was a little bit of chaos. All right, so where did I leave off? All right, so if I'm looking at this chart, and it closed red the day before, so I'm going to look at it for an entry today. I know I need to look at this entry level, and I know that I have this so far as my max risk, which is 40 cents. So what I can do is say, you know, if I don't want to ever risk more than $2 on any loss, okay, I just need to figure out how many times that risk range goes into that amount that I want to, you know, set as my max. So in this case, $2 can have up to 5 40-cent losses, so I would buy 5 shares, okay? So then I would take the amount of shares that I need to buy, so which is 5, and then I would set that equal to my entry price to see if I can afford it. In this case, it's $30.20, and then I would come back over here, and I would say, okay, does that fit within my per trade amount that I've set as a maximum? In this case, it does. So if I'm using, you know, $50 out of $200 for every trade, so I get 4 trades a day, okay? And I know I need $30.20 for this one trade. I know I have the green light to take that trade at that point because I have the technical setup. I've identified the risk range. It all fits within my budget. It's got a clean reward. I know my max loss will ever only be 40 cents, and I know that $2, and I know that my profit will automatically be $4 or more ideally. And that's pretty clean. That's a much, much easier way. So in the case where, you know, this stock opens up this day and then the price pushes down farther, right? Let's go ahead a day. In this case, it didn't. But let's say that the price dropped down to here, right? Or maybe it came down this far. Okay, it came down to 528, which means we need to put our stop loss at 527. And then we'd have to expand this up to 1 to 2. Okay, and I'm just picking random values here. So we can just use the thought experiment here because I don't remember what actually happened with this one and it doesn't matter, right? So now my risk range is 78 cents. Okay, so how many times does 78 cents go into 2? 2.5 times. So can I buy 2.56 shares? Absolutely, if I'm using fractional shares, but I don't want to do that. So I might just buy 2 shares, right? And all that does is it means that my profit and my loss will be less than that $2 maximum, all right? So if I want to scale it up a little bit, I could do 3 shares. Either way, it doesn't matter. I know exactly how much, you know, plus or minus 1 share that I can buy in order to still achieve that $2 or less max loss. And this range is now 12.89% as far as risk. Now, if I multiply, you know, this is the entry price of 6.04 by 2 or 3, I know that still fits within my per trade max of $50. Okay? So far I'm on track. Now, what happens if the risk gets really, really tiny? Okay, let's say the risk is, for whatever reason, right? Let's say it was a super tiny red candle. Okay, like let's pretend it was this guy. It's a 14-cent risk, so let's bring this down here to 2. All right, so 14 cents. How many times does $2 get to endure 14-cent losses? So 2 divided by 0.14, it's going to be 14. So 14 shares would be able to take a 14-cent loss in order to meet that $2 max loss, okay? So in this case, 14 shares times 6.05, right, because I need to figure out if I can afford it, it's $84.70. So in this case, I wouldn't be able to take that trade and still obey my max per trade amount if it was $50. Now, okay, Get Wealthy is personally using 100, so that still would have worked. But this gives us a range that we can just calculate ahead of time and not have to worry about whether or not we can, you know, accept or reject a particular risk range because we've already done the math ahead of time. So in this case, if I know if I know that a 14-cent risk is too big, right, or the risk itself is small, which is great, but the cost is too big to buy that many shares, I know that I can kick this up to a given amount, so that way I know exactly what the number of shares that I could buy would be in order for it to be within that range. So in this case, I've got a $50 allocation, and I've got 605 for my entry price, right? So I can just play with those two numbers until I figure out how many shares I need to buy to meet that that $30, I'm sorry, $50 position size max, right? So $50 divided by 605. So that's 8.26 shares, and that's my limit. And that will always get me at least in the ballpark of having a $2 or 1% max loss on any trade, regardless of the risk range. And it will get me, again, in the ballpark of a $4 profit if I follow this strategy on every trade, as long as it has a number that lands within my budget. And if it doesn't, I just don't trade it, right? And that's the advantage here, is if you can't afford something, or you don't want to over allocate, or maybe the risk range is too big and you don't want to take a 12% risk on something, even though the dollar amounts are the same, maybe you're just not psychologically ready for that, you can always pass, okay? And that's kind of the name of the game here. So if we just let this one play out, right? Like this right here was our original risk range, 566 or 565, I don't remember exactly what it was. It gets close anyway, so it doesn't matter. And there we go. So we would have hit target within the week, basically. And that's it. So some trades will go up, some trades will go down. You don't control that, and people that try to are stressing themselves out for no reason, because it just doesn't work. But we took a reasonable risk. Things made sense. The slope was moving in our favor. The price is moving up. We had a sharp pull-off, which tends to lead into a retracement. Good volume, and the price just happened to go in the direction we were already going in, and we just caught a small piece of it with a reasonable risk. And we know that we could walk away with this trade with a $2 loss or a $4 profit 3 days before this even happened. Okay, so hopefully that makes sense. Now if we look at a different example, let's say we look at this guy, right? And I'm just using the same chart here because it's easy, but this stuff applies everywhere else. Right? So if I were to enter this, okay, into my little system, and I'm just eyeballing these, I'll actually adjust them here in a minute. So the entry threshold, right? So if I move this back here to this day, okay. Let me just erase all that. Okay. Did I pick the wrong day? No, I didn't. Okay. Sorry about that. I'm having a day, guys. All right. So we're going to look for the moving average has a positive slope. We'll just start from the beginning, right? We've identified our speculation amount and our per trade amount of $100, and that's it. And then I've got the setup here, and we're just waiting to identify the entry threshold. So small red candle here. Let's go ahead and plot it. Okay, risk range is right there. Now this is pretty far away from the moving average, so maybe we pass on this one. Maybe we got this one down here, who knows. All right, let's just walk forward in time. So this one would have gotten an entry if you were okay with that bigger gap there away from the moving average. I personally wouldn't be, so let's just go ahead and move this to this candle and just not worry about the stop loss until we're actually in. Let's go ahead and move forward a little bit. Okay, so in this case, let me just walk this back one more day. All right, so this one actually touches the moving average, and this is what I personally prefer because this is where it actually comes into contact with the support that we like. So in this case, we've got an entry threshold, and we've got a low that we can use for potential stop loss if the entry is triggered. And this is something we'd see the day before. So the following day, we would already have these two levels plotted out, and in theory, we'd already know exactly how many shares we'd need. So the opening price here is 420. Okay, so I'm just going to map this out here. 420. Okay, and then the low, oops, or the stop loss level would be $3.83 because the low itself is 384, so our stop loss will go 1 cent below that, entry will go 1 cent above that. Okay. Risk range. Okay, let's break out our calculator here because I ain't doing that math in my head. All right, 421 minus 383. Oops. 421 minus 3. I probably should have done this ahead of time, but that's okay. I like sharing this stuff with you guys in real time because it's more authentic, and you guys can see whether it doesn't play out or not before I do, and I don't care because the concepts are what I'm trying to demonstrate. All right, so in this case, we've got a 38-cent risk. Okay, so let me go ahead and draw the tool. Okay, and this is something that we can do again the day before. Okay, we don't have to wait until it's crunch time and the trade is going and all that good stuff. So what did I say? 383 and 421, right? Boop, boop. All right, 421, 383, 38-cent risk range. Yes. Okay, good. So now we've got to identify our 1 to 2 take profit ratio, which is right here at 497. Okay, so 497. I'm going to go ahead and just draw that. I'm going to just skew this a little bit so I can get to it. All right, so that's our target. All right, so again, on the close of this day, we can start this process, right? We don't even have to wait for the next day if we don't want to. We can do it that night. So on June 3rd at 4 o'clock p.m., we can start doing this, okay? And then the following morning, we already have a plan for the day. All we have to do is watch it, okay? So if we kick it down to like the 1 hour or the 15-minute, we can watch the price and see what it does. So let's go ahead and watch it. All right, so at some point throughout the day, okay, we didn't get a lower low, so we don't need to move the stop loss. Our entry would have been triggered as soon as it broke over the open of the price here, the previous price, the opening, okay, at 420. So 421 we would have entered. We would have had our risk range identified, but let's figure out how many shares we need, right? Because remember, we're only going to risk $2 at 38 cents. That's another 5 shares. Okay, so at 421 on June 4th, at some point throughout the day when this broke over, we would have bought 5 shares. Okay, and that 5 shares would have been activated as soon as it broke over $4.20. Okay, so let's go ahead and play it out. And in this case, we would have taken profit right here at $4.97. And that automatically, I don't even have to do the math here. I can tell that's a $4 profit because it's double our max risk as far as the 1% rule is concerned. So maybe it's going to be a few cents off, and that's okay. But we bought 5 shares, and we know that that was a max $2 loss and a max $4 profit. And when I say max profit, I mean minimum, because you can always just use analysis once you get some experience and let that go up even higher. But for the sake of new traders just trying to be consistent, that's all you need. Okay? And then we'll just let this play out. Just let it keep going a little bit. There you go. So you got a little 5 candle rule here. And you would have locked some profits right here. And then you look for a higher low and all that good stuff, and you just keep it going, right? We've already covered that in the other videos, but hopefully you guys understand this, right? Because this risk here, 38 cents, and this risk here, 39 cents, may be similar in this example. But as you saw, this one could have been 85 or 87 cents, right? If you use the same dollar amount for both of these positions, you will get 2 very different results. Okay, so this one was a winner. If this loss is bigger than this profit because you use the same dollar amounts for the position and not for the profits and losses, you will have a net loss. And that's where a lot of traders struggle when they start to figure out strategies and stuff, because they're like, yes, I love it. I want to use, a max risk and all that good stuff, but they don't focus on their position sizing within this phase of it. And that's what messes them up, because you can have, a disproportionate profit ratio doing it this way without the 1% rule, where you're just using maybe $100 a trade, $100 a trade, $100 a trade. You can still be net negative if, your losses are still small. They're still smaller than a given size, but your profits just can't quite break out and get bigger. And the frequency just increases, and it can still work against you. So why even bother with that now that we have a plan in place? So again, just to really quickly recap the 1% rule, we get our max amount that we ever want to commit to speculation ever, right? And then within that, you pick an amount that you want to use for the day, and then per trade, okay? So since there's an overnight cash settlement now, on most brokers, you don't really have to worry about rolling 33% of your cash every day, because it settles overnight, which is pretty cool. So you just really got to focus on that, that per trade maximum, okay? So once you do that, it's pretty easy. You identify the setup. So you do some analysis, basically. That tells you where you're going to look for an entry, where you're going to look to set your stop loss, what your risk range is, and that right there, as soon as you know that, you can determine how many shares you need to buy. And your profit threshold is just twice your risk range, so that's pretty easy to figure out as well. So if I wanted a $5 risk and a $10 profit, I already know that with a 38 cent risk range, I'd need to buy 13 shares, and that's it. I know that trade would give me a $5 risk or a $10 profit. It makes it pretty easy. And that scales up very nicely, by the way. All right, so once you've got that all figured out and you know how many shares you need to buy, all you got to do is place the order at that point and just watch it. You could use a buy stop order if you want to automate it. The only time you really need to take action after you've done this initial analysis is if the price breaks below the low of the previous day, because that'll expand your risk range and you'll need to change the number of shares that you're planning to buy. And if the price doesn't break above the open of the previous day, you can just cancel that order, because it's not going up at that point, it's going down. And if that's near the moving average and all that good stuff, you can reset it up. Otherwise, if it fails the moving average, you're not in the trade, it doesn't matter, just let it sell off, it's okay. Just a missed opportunity that never happened. So once that entry threshold is crossed, you enter. It's just the number of shares that you can calculate at once and not have to worry about unless something happens with the price action. And then when you are in, all you really got to do at that point is just manage your position. So you can scale out, you can sell everything at the target, you can respect your stop loss if it stops out on you. All that good stuff is already in place mentally for you if you're at this point. And if it's not, then you can always start at the very beginning of the series and just work your way through it at your own pace. It's not a race. These are designed to be watched at your own on your own schedule, because I'd rather have you guys absorb the material than try to just catch up. But I will post this for the team members. And if you guys are watching this, a year or two from now, hopefully the 1% rule is second nature. So let's just walk through another example really quick. I'm just going to pick, I just like to use Microsoft. I just always do. I don't know why. Let's go ahead and look at it. Let's see. We got an example right here. Okay, moving average positive slope, small red candle. We got an entry. I'm going to try to find one where it doesn't work out as a profit too, because that's always important. I always just like to share. I like to do it because nobody else does it. I want to share some integrity with you guys. These are all profitable. Like, that is insanely small risk and a nice profit, but I'm just trying to find one that touches the moving average and then stops out. So yeah, here we go. Let's use this guy, right? So I just want to walk you guys through this. Okay, now this obviously can't be traded on a super small account because it's $330 per share, but we can still look at it. All right, so let's say we're looking at the positive moving average slope right here. This is on the daily time frame. We've got our entry. We've got our stop loss goes right here. We've got a 1 to 2 risk reward right around here somewhere, right? So this is a $4.31 risk range, okay? So if I want to make $100 on, if I want to have a max risk or max loss of $100 or less, I can just divide that by $4.31. And I know that I would need to buy 23 shares. Now, if I can't buy 23 shares of Microsoft at $330 per share, I shouldn't even be looking at this setup, right? Because that will automatically cause me to over-allocate. But now, I know that if I buy 23 shares, I will have a $100 loss or a $200 win. And that's all I need. And I'd know that the day before. As soon as this day closes, I can do that homework. And then as soon as this day opens, I'd have to move the stop loss here. This is kind of why I chose this example here. Because when this day closed, okay, that was the original range, and then the price moved down, which caused me to expand the stop loss, the risk range, okay, and that's why we're doing this 1% rule. And the target moves as a result of that. So same ratio, same exact dollar amount, right? It's always going to be a $100 max loss, in this case, $200 profit. But the actual risk range is different, and that's what keeps my account regular when it comes to speculating, okay? So now if we go back here, okay, and I look at this guy, let me just erase all these. All right, let's just draw the tool. I'm not going to go too crazy here. I just want to draw the tool and just kind of show you guys the example. It's got to go up just a little bit. There we go. That's where my stop loss goes. Does this make sense? Positive slope, small red body, disproportionate profit. Okay, so there's our 1 to 2 ratio, roughly. Okay. So in this case, it's $2.15. So $100 goes, $2.15 goes into $100 46 or 47 times. Okay, so 46 shares gets me a $100 loss or a $200 profit on this trade, no matter what happens. And no matter how big the risk range is, I can always figure out how many shares I need to buy. And then I can use the share price to figure out if I can buy those. And if I can't, no trade. Okay? But then I know if I take 200 trades in a row, I'm going to have $100 losses or $200 profits, and that's it, right? And if it's K Get Wealthy in his smaller account, he's going to get $2 losses or $4 profits, and that's it. Okay? Nice consistent data. And then once you get comfortable and all that good stuff, then yeah, you can use the 5-candle rule, you can use the higher validated lows, all that good stuff. But if you're struggling with, maybe you have a 50% win rate and you're still negative somehow, even though you're using a disproportionate ratio and all that good stuff, it's probably just the actual sizes of the risk ranges that you're using. And that's something that we can obviously put a filter in place by saying, okay, I don't want my risk range to be any more than 30 cents. Or you can use something like the 1% rule to guarantee that your dollar amounts will always be the same no matter what the risk range is, percentage-wise. Okay, so the beauty of math is that it's inverse, right? You can always flip stuff upside down. So in this case, this is a $3.58. So $100 divided by 358, 27, 28 shares, right? $100 loss, $200 profit, easy peasy, right? Now again, it's going to be a little slippage, but it is what it is. All three of those setups have the same exact end result as far as dollars, in that they're only one of two potential dollar amounts, right? $100 loss, $200 profit in that example. Now in this case, the price is $426. So can I afford that? 26 times 426, that's $11,000, 502. So my 50K portfolio, absolutely. I've got some APLD that's about that size. But if I'm on a $2,000 account, I'm not going to take out a mortgage to trade Microsoft. All right. And that's it. I don't want to ramble too much more because I said this video would be short, but hopefully this all makes sense, and hopefully it's something that you guys can start to implement. I can very easily make you guys a spreadsheet for this if it helps to have a tool, or I can just make a computer program and you guys can download it and use it if you want. But it's really, there's a lot of value in just working through it step by step on your own and understanding why you're doing the things you're doing. So in this case, let's just grab Apple. One more example. All right. Let's use this guy right here, the most recent one. Okay. It's a $200 stock, so if I don't have a $200, like if I can't buy at least one share or the number of shares that I need to buy, I shouldn't even be looking at the chart. All right. So let's say I'm on a $30,000 account and I want to risk no more than $300 on any trade. Okay. So let's just map it out. So 30,000, and I want to risk no more than a $300 loss. Okay, so my max loss is only ever going to be $300. So in this case, I've got this set up. I mapped it out the day before. All right, let's go ahead and map it out. All right, so I've got my entry threshold, I've got my stop loss threshold, and I've got my target 2 times that distance to the upside. I've already got the tool drawn, so you guys can see that. Boom, price enters, right, crosses that threshold, I enter. But before that, okay, the day before, I've got this risk range. It's $4.91. Okay, so all I need to do is figure out how many times that goes into $300. So 300 divided by 491, 61 times. Can I buy 61 shares? I have no idea. Let's go ahead and see what the price is. So 196.91. It's $12,000. 12,031. All right. So can I afford that? Yes. Am I going to use all that for a swing trade for one position? Maybe, maybe not. If I'm using half my portfolio per trade, 15,000, that covers it, and I can get into that trade. Now, I know that my max loss is only ever going to be $300. That also tells me that my profit is going to be $600. Okay? So in this case, if I just walk through time, okay, I didn't need to move my stop loss here because it just went up. It broke above. It didn't break below. I would have hit that within the same day. And that's all it really takes. So this is June 11th, 2024. So let's kick it down to the 1 hour. All right. So the low is here. The day opened right here, the day before, and this is where the day closed, right there. So this is what we saw the day before. And then we plotted the opening price and the low of the day before. Price opens, breaks up into market open, and push, push, push all the way up into our target. We leave the trade and we don't care. Right? So now if I could just kick this back up to daily, I mean, obviously you guys can see that things tend to go, a little bit out of control sometimes, but you can't beat yourself up for not being in that all the time. So it's best when you're newer and you're just kind of getting consistency, just focus on getting the quick base hits. Like, you'll get the monster runners later. I see a lot of people like beat themselves up and pass up perfectly good profits because they always want to catch the tops. Don't ruin yourself and your portfolio by trying to do that, guys. It's not good for you. It's just going to stress you out and lose money. Take the good stuff. All right. So with that said, I'm going to end this episode. Hopefully this helps. Again, it's a little bit of math, but it's really not too complicated once you boil it down. You're really just figuring out how many of these little risk ranges, dollar amounts wise, you can endure before you hit your max loss on that trade dollar wise. Okay. So in this case, $491, that goes into $300, so many times. That's my number of shares that I buy. Okay. That guarantees, plus or minus slippage, that I get a roughly similar loss and a roughly similar profit across all my trades. Okay. And if this risk range was 1250, right, 300 divided by 1250, that's 24 shares. 24 shares times 196.91, $4,000. I can afford that. That's pretty easy on that portfolio. So $4,700 gets me that. I get the same exact end result as I did for the $12,000 trade. Okay? And I get a bigger risk range. So, but if I took those two trades side by side and I used the same dollar amount, bought the same number of shares, this one would have a much worse outcome because the risk range is much, much bigger. It's more than twice the size. Okay? So that's the goal here, is we try to get everything as consistent as baseline as possible, and that helps us make cleaner decisions and have more clear data to look at so we can focus on things like, you know, did this trade stress me out? Did I let that stress influence my decision making? Am I going to do that on my next trade? Okay, that's why we're here. So we can try to make it as mechanical as possible. It's worth the extra math, in my opinion. So let's get you all there. And I hope everyone has a good day. Bye.